So without any further delay, I'm going to hand over to Nicky Weimar. She's Nedbank's chief economist, and she's going to give us her 5 key points for looking at the economy in 2021. So I hand over to you, Nicky.
My aim today really is to talk a little bit about the 5 things we need to sort of watch out for next year, which of course is always tricky to look forward. If 2020 proved anything, it's that economists don't know a lot about viruses and disease, but we have been called upon to sort of deal with the issue. So obviously the very first thing we need to look out for is what is likely to happen in terms of the vaccine. The world now has essentially got 3 effective vaccines against COVID-19. The first being, of course, Moderna, the second being Pfizer, and then the last one being cooperation or joint venture between AstraZeneca and Oxford University. In terms of the first 2 vaccines out there, essentially it's very difficult to transport and it's very difficult to roll out and distribute because it has to be kept incredibly cold. Apparently, you need to transport it in an ice block straight from the North Pole. That sort of effect of what we're talking about. It only will last half a day in a normal fridge in a doctor's speaking room. So the outcome is that that's not all that practical, but what the world is getting excited about at the moment, of course, is the AstraZeneca vaccine, which is cheap, easy to produce. It entails 2 stabs that you get, and it's proved to be highly effective. There are some concerns about the dosages they provided. There were some mistakes in that, but overall the outcome has been effective. So that is good news. And given that it's easy to produce, easy to distribute, and also fairly cheap, orders have been flooding in from all over the place. I understand the French have already received dosages, and they will start their inoculations during the course of December, and so has the UK. And they all hope to have at least the most vulnerable groups in society vaccinated before Easter. So things are moving forward very, very quickly on that front. And of course, that's been very, very good news. But for South Africa, sitting, at the far end of the African continent, and for the whole of Africa, it really is a question of how quickly will we be able to secure vaccines? I know the talks are ongoing. I know government has engaged in contracts, and they are, ready to proceed, but clearly it's not going to happen as quickly here as it will elsewhere. And so that's the reality. The world at the moment in Europe, they have been in the grips of a vicious second wave of coronavirus infections, which is what this graph shows you there. They're starting to get that under control, but in order to do so, of course, they had to impose new shutdowns, especially in the Eurozone and the UK. The shutdowns this time around has not been nearly as strict as we saw in April, so it's not going to cause quite the implosion in economic activity that we saw in the second quarter, but the anticipation is that in the final quarter of this year, the Eurozone will relapse. GDP is expected to shrink in the Eurozone and also in the UK. The impact on the world economy, which is what matters from a South African perspective, won't be so severe because you have a bit of a counterbalancing force. You have essentially the US, which, although they, as you can see, are struggling with a third wave of coronavirus infections, and I read this morning in the FT that essentially the hospitalization rates have hit records throughout the US. The reality is that they did not impose lockdowns. And remember, it's the lockdown that does the economic damage, not so much the virus. The impact of the virus on economic activity is more through productivity, through fear of contagion. It's not so much on your actual output levels. So in the US, growth has continued, although at a slower pace. And all of that will also be countered by Asia, where they appear to have the virus very nicely under control, and essentially they're chugging along, no problems there. China has actually hit record levels in terms of industrial production, and they are really, interestingly enough, experiencing capacity constraints that came through in the latest purchasing managers indices, so much so that they're struggling to keep up. And the sector that's growing the fastest in terms of manufacturing is everything to do with electronics. So that's quite interesting from that front. So the world economy, certainly the outlook for 2020 looks a lot brighter. That's what the vaccines did for us. To be honest with you, there are few things in the world that can be solved by one thing. But lockdown and pandemic, that is one of those things that can be solved by a vaccine. So that's an encouraging development, but the extent to which 2020 will produce a faster and swifter recovery than perhaps we initially thought would depend on how quickly we can roll out these vaccines and they can come to South Africa. The second thing I think you need to watch out for in the very short term especially is whether South Africa will be experiencing this dreaded second wave. For a long time, our infections or new infections on a daily basis was stable at around 1,500. And then it started picking up to around 2,000 and then to around 3,000. And I see yesterday's number was at 4,000. And it might be what the president wants to talk to us about tonight. So we are seeing a pickup. It's nowhere near where it was during the peak rate of infections, where it was around 14,000 per day, but nonetheless it is picking up. And then, of course, our short-term prospects might be ruined to some extent if we do go forth and implement far stricter lockdown measures or containment measures. So that's the second thing we need to watch out for, but I think it really does only apply to the very short term. On a global front, one of the interesting things, of course, is that I think investors seem to be in two pools at the moment. There's the one group that is fearing inflation and global inflation, and there's another group that is fearing deflation. Among the groups that are actually fearing deflation, it would be all policymakers and it would certainly be all central banks. And then, of course, among your private investors, there is also a fear of deflation. So what we're seeing in the world economy at the moment is, of course, a situation where, as a result of the coronavirus, as a result of the pandemic, as a result of the lockdown, the enormous economic damage that did to global economic output and to global economic activity, to employment levels the world over, to household incomes and household wealth the world over, we have seen that policymakers stepped in very aggressively during the course of 2020. And the US Fed was, of course, at the forefront of the response to the coronavirus and most certainly the response to the lockdown. And they really slashed their interest rates to near zero. So we're back to the sort of levels that prevailed during the global financial crisis for US interest rates. And they, of course, started printing money. In other words, they expanded their balance sheet at a very aggressive pace. They were followed by the United Kingdom. They were followed by the US, and then, of course, poor Japan. They've been stuck in negative interest rates for an extended period of time. And, of course, they have been undertaking quantitative easing for an extended period of time. So we've now had a situation where all your central banks have expanded their balance sheets dramatically, and they've kept interest rates in your low-risk countries near zero. Okay, so that means for a low-risk investment, for a safe investment, your return is really an impotence at the moment. We have, I think, at last count, about 17 trillion US dollars of negative yielding bonds out there. And that really, of course, does encourage risk taking. And at some point, you will have that. And that's what we're seeing at the moment in the world economy. With the vaccine, the prospect of a return to normality has improved greatly, and investors are looking forward to a much brighter 2021. Risk on has returned, Risk appetites have improved incredibly, and as a result, you've seen the dollar hit a 2.5-year low, and you've seen investors return to cyclical stocks the world over. So they're looking a little bit further than your pandemic-resistant stocks like pharmaceutical companies and tech companies. They're looking a little bit broader to your cyclicals, and they're also looking to emerging markets, specifically emerging market equities. But the assumption, of course, is that we're going to have a very similar type of rebound than we had after the global financial crisis. But the reality is they're printing money at an incredible pace at the moment. Interest rates are very low, and we're sitting with the highest debt levels since the Second World War in advanced countries. This graph shows you a long history of global debt. It comes from the IMF. There, the blue line is advanced nations, and here are your emerging markets. So as a result of coronavirus, most governments in both advanced and emerging markets had to take on additional debt to stimulate their economies, and debt is now at record levels. Now, normally, this would be something that would be supportive of a deflationary environment. In other words, there comes a point where the system simply cannot take on further debt, and the key interest and preoccupation of governments become trying to reduce that debt burden, and of essentially companies becomes not about earning profits, but about restoring their balance sheets. And this is not just a public sector concern. I show you public sector debt here, but private sector debt is also very high. And the pandemic, low interest rates, the special arrangements that many banks have had to make in order to keep clients afloat have encouraged some highly indebted firms that would probably have folded during the pandemic, the so-called zombie firms. It's given them a lifeline, and they can either use this or they can lose it. But the reality is there's a lot of debt in the system. Normally, that is a deflationary issue. However, in this environment, you may see a very strong rebound. You may also see capacity constraints in certain areas. And it's very interesting in the latest PMIs, even in China, all companies are reporting a surge, literally in production cost. Their input costs have increased quite dramatically. And they've also found it quite easy to pass it on to the consumer. Now, that is the beginning of inflation. So it's very difficult to see where the world is going at this point. My sense is that we'll probably have subdued inflation in the years to come. We'll probably, well, especially in 2021 and into 2022. But if this stimulatory stance remains into 23-24, as the Fed has indicated, they will keep rates for as long as it takes to bring unemployment back to its minimum level and employment to its maximum level, which they've indicated could be as long as 2024, then perhaps towards the end of this spectrum, we are going to deal with inflation, right? So this is something investors should be watching very closely. What happens to company cost profiles, and very importantly, do they have pricing power? Do they have the ability to pass it on to consumers? Because that's when you will deal with inflation. Then, of course, the fifth element that I think I do need to address is South Africa's debt situation. You all know it's dire. And really, government's plan to eventually bring the budget deficit, which this year will hit 15.7% of GDP. And in order for them to bring it down slowly to around 7% of GDP over the next 3 years, it really entirely rests on them being able to cut public sector wages and salaries. And this is going to be a battle against the unions. Sadly, they are already conceding. And as you can see, there's good reason for them to try and contain public sector wages and salaries. Here I show you a graph of real wages after adjusting for the effects of inflation, indexed back to 2008, and you can see the movement of both private and public sector wages from that point in time. And you can see as the screws tightened on the economy, growth started to evaporate, confidence evaporate after a decade of corruption, of ineffective public policy, of rising budget deficits, of the private sector really being crowded out of the capital markets, that private sector wages first completely stagnated and it is now actually falling. And it will probably fall further before it will improve. But in the public sector, it's been a very different story. Look at that acceleration in public sector wages. So they've made absolutely no sacrifice for the difficult situation in which South Africa finds itself. And I think it is about time that they do it. But in order for them to achieve it, of course, it will be a battle against the unions. I see they've already folded. They've given a 29 billion rand concession in order to get out of increasing salaries this year to the unions and to public servants, taking the form of special payments and so forth. But of course, if they manage that and they can keep the wage bill and cut it in the years ahead, that would be a good amount of money to pay to get discipline over the next 3 years in the next contract. But I think we are up for a battle. And of course, government would like to lock in whatever agreement they come to for the next 3 years. That will help them a lot towards stabilizing the debt burden. Listen, they're not going to bring it down. That's not going to happen. But they can perhaps stabilize it around this yellow line, which was the plan of the mini budgets, where our debt burden actually peaks at about 95% of GDP. And the aim was that if you could cut public sector wages, you could slow that beast down, then perhaps you could maybe prevent any further escalation in your debt burden. Is it important? How big is our problem? It's enormous. It's incredibly important. So we've got a big problem and it's incredibly important. This is gross loan debt in 2020 as a percentage of GDP for all emerging markets. You can see there's your emerging market average in red, and up there at the top is South Africa. We are by no means the worst of the bunch, but if you just look at the increase in our debt burden, that's a very different story, which I'll show you in a second. And if you look at what's going to happen to our debt over the period to 2025, we suddenly very close to the top. We fall only behind Brazil, Algeria, and Sri Lanka. That's where our debt burden will settle within by the time we get to 2025. So this is why it's absolutely critical that government act now. What is the absolute increase in our debt burden as a percentage of GDP? Well, there we are at the very top. So we experienced the biggest increase in our debt burden of all emerging markets in 2020. And over the next 5 years, we will be the second biggest in terms of the increase in our debt burden over the next 5 years of all emerging markets. So the bottom line here is that we have a very, very weak fiscal position. We are now at a situation where our sovereign risk ratings are essentially just above the level where the risk of default is considered very high. If we get downgraded further, we will fall in a bucket with Argentina, Ecuador, Venezuela. That's the naughty corner of the world economy. Nobody wants to be in that sort of company. So that will not help South Africa's case whatsoever. So it's absolutely critical that government succeeds. They have set themselves a modest goal, let me tell you this. But the point is, what this tells you is that government's prime priority should be to bring debt under control. They are in no position to provide stimulus. And really, in fact, government will be a drain on economic growth over the next decade. We are not going to get rid of this problem over the next 10 years. So government spending will be contained, and that will be one element of demand that will fall away. Right, so that's the situation we find ourselves in. These are, for me, the 5 most critical elements. And when we work all of these constraints or issues into our forecast, we expect GDP only to return to 2019 levels, which remember wasn't awe-inspiring levels to begin with. You now sit with a situation where we only get back to that level by 2024. We are not alone in this. This is the IMF's outlook for South Africa. You can see among emerging markets, when you compare us with our peers, This year, we are not recording the sharpest contraction by any means. We really don't look too bad at all, even though it is a very ugly picture, a -8% contraction in GDP. But here's the point. Our growth prospects are very poor. So if you look at South Africa's economy, anticipated by the IMF, we will be among the worst performing emerging markets as far as economic growth is concerned. They expect the economy to grow by only 0.3% per annum between now and 2025. So we have a tough battle ahead of ourselves. We can do better if we deliver a little bit of policy certainty, if government allows the private sector to get on with the business that the private sector is good at doing, which is really creating wealth. And if the government deregulates transport industry, deregulates the energy industry, South Africa can do a lot better than the IMF is anticipating. But at this point, indeed, our growth outlook looks fairly subdued. This year, we decline very dramatically, and then we expect about 3% growth next year and about 2.2% the year thereafter. So those are the 5 things I think you should look out for. What happens with the virus, whether South Africa has a second wave, and very importantly, what happens with the deflation versus inflation debate. It will have a lot of implications, very significant implications for your investment portfolios. And then ultimately, how do we cope with the debt monster in South Africa, and how significant is that impact on economic growth?